It's Thursday in the garage, and the market just rolled off the straightaway and into a high-speed corner. The dash lights are flashing, tires are chirping, and the casuals think the car's coming apart. It's not. Bitcoin dipped below 90,000, Ethereum slid under 3,100, Solana's sitting around 134. That's not a blowout, that's breaking before the apex. If you're only watching price, you think something broke, it didn't. This pullback didn't come from panic. It came from positioning. Overnight, we got one of the most important macro prints people are completely ignoring. The U.S. trade deficit collapsed to $29.4 billion, the smallest since 2009. Wall Street expected nearly double that. That's not noise. That's a massive GDP positive shock. A shrinking trade deficit means less capital bleeding out, stronger balance, and cleaner growth math. In plain English, the U.S. economy just showed more strength than the market priced in, and strong data forces short-term de-risking. At the same time, continuing jobless claims ticked higher, not crashing, softening. People are taking longer to get rehired. That's late cycle behavior, and it gives the Fed room to move. And then the tell you don't ignore, the Treasury Secretary openly urging more rate cuts. When Treasury speaks like that, it's about liquidity, debt servicing, and growth optics, not vibes. But here's the piece most people are missing. The stress isn't in stocks, it's in bonds. Bond volatility is elevated while equity volatility stays asleep. When bonds are nervous and stocks are calm, history says trust the bonds. That divergence usually resolves with a sharp repricing. Add to that the quiet wrecking ball out of Japan. The Bank of Japan has lifted rates, pushed long-term yields to levels not seen in decades, and that starts unwinding the global carry trade. Cheap money that used to fuel tech and crypto is getting called home. That's not a headline, that's a liquidity drain. And then you layer on geopolitics. Venezuela just injected a real war premium into the market. Energy risk is back on the table. And in that environment, Bitcoin isn't trading like a tech stock, it's trading like a sovereign hedge. So let's connect the dots. Stronger trade data lifts GDP expectations. Cooling labor supports rate cuts. Treasury wants cheaper money. Liquidity is tightening globally, but fear is rising faster. That combination doesn't scream recession, it screams controlled deceleration with volatility ahead. Which brings us back to crypto. Bitcoin under 90 isn't fear, it's leverage resetting. Ethereum under 31 isn't weakness, it's rotation pressure. Solana at 134 is profit-taking, not abandonment. This is capital easing off the throttle, setting the line and waiting to punch it out of the corner. Because real money doesn't chase green candles, it times exits and entries. In the garage, we've seen this lap before. Pullbacks during macro tension are reload zones, not exit ramps. Brakes set, apex in sight, throttle coming back on, let it rip.